Hi, everyone. Welcome to another webinar from uLaw. This time the topic is going to be about bookkeeping, compliance, what you need to do, and what is expected of you as part of compliance is what we'll be concentrating on. This webinar is accredited for 1 hour of professionalism credits by LSUC. So if you're from Ontario, and you would like to get, the accreditation, please don't forget to send us an email, after the hour, saying that you attended the whole 1 hour of presentation. So with that housekeeping, I'm going to get into the presentation. What we're going to do is we're going to talk about compliance, how much time it takes to do it, and can it be more efficient. But first, let's talk about compliance. What do you need to do as a legal practitioner, on a daily basis with respect to bookkeeping in the topic? So what I would also like you to do is send your questions via chat. Praveen is collecting them, and I'll keep like 5-10 minutes at the end of the presentation to answer all your questions, and we'll take it one by one. So the agenda for this presentation, we're going to look at mainly the topics around bookkeeping. We're going to look at the definitions of trust and general ledger. What does it take to maintain them? We're going to look around that. We also are going to look at journals, like, what are receivable journals and what are disbursement journals, and various forms of them. What does it mean to have trust receivable journals and general receivable journals, and same way for disbursement. So we're going to maintain on how do we maintain them. That's going to be the topic. Then we're going to talk about reconciliation. How often should you do? How complex is this process, or is it actually a simple process? How can you simplify it? What are some of the thought processes that you need to have in your business to simplify reconciliation? Then we'll also talk about other documents that the law talks about, like fee books. And why should you even have a fee book? We'll talk about why this compliance even exists in the first place. We'll talk about Form 9A, deposit slips, and other documents. Then we will talk about what we call seamless accounting, where what are different ways of doing this, all these accounting? Should it be as complicated as what it is? And last, we on software. We'll touch and see whether what is legal accounting software, and why should you be using it, and in what way can it actually benefit? Again, the chat lines are open, so keep sending your questions to Praveen, who is collecting them, and I'll try and answer them at the end. And housekeeping, at the end of the webinar, please send us an email at info@uLawPractice.com confirming your attendance. Also, we would like you to rename your session in Join Me. So just go and, rather than calling yourself viewer 15 or 16, just rename it and put your real name, and Praveen will also mark that attendance as well. So let's now, at a top level, look at what are some of the accounting systems that exist today that can help you in managing a business. Now, what I have on the right side is not something that we made up. This is actually page 5 of the bookkeeping guidelines from LSUC. So as you clearly see, they talk about 5 different types of accounting systems. And let's delve through each of them and try and understand what it means to have each of these accounting systems. What are some of the advantages and what are some of the disadvantages? Okay, so let's first talk about the first and foremost one. It's called the manual double entry system. Now, why do they call it the double entry? Is because when you look at transaction, which is any kind of money that moved from X to Y, it always means 2 things. Because if money left from one place to go to another, so it has to be looked at as if it was credited from one place and debited in another place. So that's why they call it double entry, because the same money is actually put in 2 places. A good example is, let's say, for example, somebody had a disbursement and that you actually paid using your general account. What you do is you basically credit your bank, basically because you removed money from your bank and you paid that, but you also debit, your expense and your HST, payable. The reason why you do that is because you want to record that same money in two phases, one as a credit entry and one as a debit entry, and that's what they call as manual double entry systems. Now, these are pretty simple to maintain at a very high level. They are obviously inexpensive, basically because you're not buying any software, you're just doing it all yourself. You can do it using spreadsheets and all that stuff. Now, the primary disadvantage of having something like this is basically it's very time consuming. Because every transaction you got to record it twice. And there are several things that you need to record. First thing is you need to record the date, then you need to record the description, you need to record the amount, then you need to record memo, like whether it was like a check or this. And on top of it, you need to do it twice, once as a credit entry and once as a debit entry. Now, that's pretty much unsustainable, even though it's an option, okay? It does not automatically post subledgers, and that's an accounting term. Let's skip that for now. We'll come back to details later. And when you do things twice, arithmetic errors are going to be high, and that's what is laid out in this table. Manual double entry possible, but it's going to be very highly error prone. Let's look at one write. Now, one write is simple. That means you basically do it only in one direction. It's inexpensive. You can post subledgers. Everything is there. The problem is it's pretty time consuming, and the arithmetic errors that you have in the manual double entry don't go away here as well because you're doing everything yourself. So that's going to be always part of the whole issue of doing this, either using manual double entry or one write. Let's now look at the third methodology, which is spreadsheet software. Excel is already available. Maybe you already have a Microsoft license, so you have Excel. So you can use Excel to actually do your accounting. So what you need to do is you basically create a sheet for every account. For example, your bank can be one sheet. Your cash can be one sheet. Your expenses can be one sheet. Your revenue can be one sheet. And then what you do is Excel allows automatic calculations. So, for example, you can sum up all your total in the bank very easily. You can get your balances pretty easily. So that's the advantage. Again, it's inexpensive, but it's, again, very time consuming because every transaction needs to be recorded. Everything needs to be proper. If multiple people are maintaining these Excel spreadsheets, then you need to have a lot of training between the people, on how to do it. And again, the errors don't go away. The arithmetic errors are there because you could have had an incorrect formula or something like that, and that can cause you a lot of grief. So that's the disadvantage that you see because of spreadsheet software. Now let's move on to the next level, which is general accounting software. Now, general accounting softwares, I would say softwares like QuickBooks, Xero, these are all built for accounting. They have a purpose for doing this. They're not like spreadsheets. They do a lot of automatic calculations. They have a lot of accounting knowledge. They do things the right way. But the problem is they are not designed for legal accounting. And they don't have a concept of trust. So because they don't have a concept of trust, they don't put the compliance required on trust when you use it. For example, if you're using QuickBooks, it'll never tell you that you have a trust violation, right? It'll never tell you, and it'll never prevent you from having such a violation either. So to us, when we look at general accounting software, it does the work because you can produce financial reports. It does all the proper work. Obviously, it requires training, top accountants use softwares. The problem is because it does not do trust, you're still exposed with respect to law society audits because when the law society comes to you and they're auditing and they're seeing it's QuickBooks, they will exactly know what kind of errors you can commit in trust, and they will be looking for that. So that's the problem of using a general accounting software. Legal accounting softwares are one step above general accounting software because they are purpose-built with workflow for a lawyer or a paralegal or some legal professional that we are talking about. So they have designed in trust accounting and general accounting. They basically do all the automatic calculations like general accounting, and they post subledgers, and they produce all the financial reports. So that part of advantages is superior. Now, obviously, anything once you talk accounting, just definitely requires training because you're not talking about softwares that are managing your money and your workflow, so you require that. But on top of it, they are expensive too. Like, if you think QuickBooks and Xero are expensive because, like, they come with an accountant and all that burden, these are even more expensive than that. Like, that's why legal accounting softwares, have that as a disadvantage. So when you pick a software that does practice management, you obviously need to look at two elements. One is the good workflow that comes with practice management and all that stuff. But the Law Society guidelines go beyond that. They are not just looking for you to have a practice management software that, that manages your practice at calendaring and, task level. They are more looking at it from an accounting level to see, are you accountable properly in trust? Are you accountable properly in your general? So to summarize on this slide, manual double entry, OneWrite, and spreadsheet software are all inexpensive, but they are not pure. They're very highly error-prone accounting systems. General accounting softwares like QuickBooks, Xero are good. They do the job, but obviously they are not designed with trust in mind. The pick should be somewhere like, here to say the best legal accounting software that kind of does the workflow for you, but also goes a step ahead of actually managing, your accounting properly. Okay. Now let's look at. Now let's get into the definitions of each and every requirement, and let's see what it means and how you actually record them, and then how softwares will automatically record them. So let's look at both of them in parallel. So what is ledger, and what does it mean by saying trust ledger, and what does it mean by saying general ledger? So let's understand each of them. Ledger is basically, a bookkeeping entry where you have noted down a transaction, with respect to either, it's in its form of receipt or in its form of payment, okay? And in each of these areas of trust and general, ledgers will vary. In trust, the two elements of debit and credit are basically receipts and disbursements. So what happens in a trust ledger is you will say on 30th, excuse me, mortgage advance was received, and on 31st, it was transferred to Taylor. That's what general ledger is actually talking about. Or this one, for example, we got a retainer for $565 on July the 5th. On July the 14th, that was paid to the corporation as part of an invoice number 2. That's what this general ledger is actually recording. Trust ledger is actually recording. If you look at general ledger, it's a little bit more expanded because what you actually, I would say what you actually recorded, has a couple of more details than just the amount. The total general ledger is split into two parts. One is what the real fee is all about, and the second part is the tax associated with it. For example, on July the 2nd, under this, this person, Jackie Jones, and for her matter, legal advice, we raised an invoice number 1. It was for $100, and the HST for Ontario was calculated 13%, and that's why it's $113. And on July 22nd, the client actually paid that, and that's why we have, the $113. Now, let's look at Peter Piper. Peter Piper, as far as trust goes, he gave $565, and $565 was withdrawn from trust. That's awesome with respect to trust ledger. But if you look at the same thing in general ledger, you actually raised him a fee on July the 12th for $500 with HST of $565, and this $565 that he paid is actually the payment on the account, and it was done as a trust transfer. That's how you would record it. So if you were doing this manually, you can already see for Peter Piper, you have 4 lines that you need to record. When the money came in trust, when you actually raised the invoice, when you removed it from trust, and when it got deposited in general. So ledgers basically are bookkeeping entries that basically describe, the in and outs, trust and general, and in each of them, they describe the flow in or flow out. So we also record the tax associated. Now, let's go. Now, there are other You need to also manage the ledger. One is called the running balance. Like, for example, here, when you do like $113 is what the balance the client owed, and then once it got paid, it became zero. Now, if this transfer never happened, you immediately know that the client actually owes you that money. Similarly here, trust balance means like, you have taken that money and you haven't basically invoiced and transferred it, or it's still sitting in trust, waiting for an expense to happen, right? So that's what balance in trust actually means. What is journal? Now, journal is basically another bookkeeping record that you need to maintain for exactly, the same thing that as ledgers. But here, the records are a little bit different. What here is recorded is you record the date. Let's first talk about trust, and then we'll talk about general. And within trust, there are two. One is a receipt journal, and one is a disbursement journal. And similarly, in general as well, there are two. There's a receipt journal and a disbursement journal. So let's talk about the Peter Piper example, because that was very clear. Money came in trust. We did the work. We invoiced. And then, we drew it. So let's look at it like that will have an entry in all four areas. So let's look at this one. So Peter Piper, right, on 5th of July gave us $565. The method was checked. That was recorded as a receipt journal. Now, if you look at it in the back slide, it got recorded here as a receipt in the ledger, and in the journal also it made its way as a receipt. Okay? Now, when the invoice was actually raised for Peter, it actually went here, and it said in the invoice we actually recorded it, okay, as $565 on July the 14th, and we said that's a trust check that we actually paid ourselves. And you will also see that, from here it made it here. Here, this is where, we actually transferred it. That means it left trust and it made its way into general as $565. So again, to summarize, the entry that we saw here, $565 in trust, the invoice and getting paid actually translated into a receipt journal of $565 and the check number should have been recorded here. And this is the event where it left trust, and this is the place where it actually arrived in general. So this is the recording that you're actually doing for receipt. So already you see now, as part of the requirement, you need to maintain 6 documents: trust ledger, general ledger, and then trust receipt journal, trust disbursement journal, general receipt journal, and general disbursement journal. So these are the 6 basic entities that you need to maintain. Now, ledgers are actually grouped by client and the matter. So you see here now, the date and all that information is grouped by client and the matter. That's how ledgers are grouped. Journals are just grouped by time. This is chronologically increasing in time, and that's how you maintain. But what you also maintain is method, the check number, who paid to. Here you have receipt from, and then here also you have receipt from and the source and the description, amount, and the method is maintained wherever possible. Now, in general disbursement journal, you also maintain, basically the split of, amount and HST as well. Okay, so that's maintained as well. And now let's basically look at the next, requirement, which is a reconciliation. What is trust reconciliation? Let's first look at that. We'll examine why do you need to do that, and what are some of the steps that you need to take, and when do you have to do that. Now, reconciliation, by its definition, means that you're maintaining all these books, right? You're maintaining, as we saw here, you're maintaining these 6 documentation. Now, what the Law Society is asking you to do is on the 25th of every month, or a little bit here and there, they want you to make sure that your books are actually matching with your bank, and that's the process of reconciliation. They're basically asking you to take a record of what is there in the bank with respect to bank statements. Take your 6 recorded entities match out the entries that are new from the last time of reconciliation and make sure that everything that you recorded is properly managed in the bank. And sometimes there might be some huge surprises, and you want to catch them as part of your reconciliation so that you can fix them immediately so that the next reconciliation you don't have that error. Okay. Now, let's look at a classic example, of a reconciliation error with respect to banks. Like, for example, sometimes trust accounts are not supposed to be charged with fees. The fees are supposed to, the bank charges are supposed to come out of general. Most likely, when you set up the trust account, invariably the banks do this mistake and they start charging you those amounts. So when you look at the bookkeeping records that you're keeping in trust, you are not having any column for bank errors. It's basically like, it's a client and the matter. So when you sum this all up, it's not going to match what you have in the bank, basically because bank has actually withdrawn some money in the name of bank charges. So you will catch that only in the reconciliation process. So the first part, they're talking about maintaining good documentation. When we talk about reconciliation, we're actually saying that we need to make sure that the maintained documentation matches with what is there in the bank. So if you look at bank reconciliation, there are primarily 4 steps that are involved in trust reconciliation. The first step is very clearly recording what is in the bank. So the first step is you need to know your bank statement on the 21st or 31st, whenever you're doing the reconciliation. In this case, they have done it on August the 31st, so you need to have your bank balance as of that date. The second thing that you need to know is how many checks are outstanding. Like, basically, these are checks that you have returned and the opponent party has not cashed it yet. So in your bookkeeping record, the balance would have already dropped, because you already said, hey, this $40,000 was withdrawn by Taylor and I don't have that money. But in the real bank, Taylor may not have deposited that check and that money could have not left. So there could be a reason why a certain check is still outstanding. Okay. Similarly, the same thing can happen with deposits. People are giving you, checks or doing money orders or doing some form of transfers, maybe even, electronically paying you. What can happen is there are some days when, the bank needs so many business days to actually do the transfer. So you might have a record saying that I've got the money, but bank may not have the record yet. So those are called outstanding deposits, where you actually physically went and deposited it, but bank is still showing that money not there yet, basically because the money hasn't made it into the bank. So those are outstanding deposits. So first you get your bank balance, then you list out all your outstanding checks, and then your outstanding deposits, and then you make sure that there is no bank errors. So once you've recorded these, you lessen your outstanding checks, add your deposits. Now, bank errors generally are a plus, basically because bank has done a mistake, but sometimes they can be negative too. Like, for example, accidentally the bank deposited interest, without knowing that this is a trust account, then it is a negative error. So, so those you will record, and then you will add them all up, or add and subtract them, and that will be your balance as per the bank. So you take your bank balance, take all the outstanding checks, you take all the outstanding deposits, lessen that, add that, do the proper thing with respect to bank error, either add it or subtract it, and then do the mix, and then finally what you do is you just sum it up, and that's your mixed reconciliation statement as per the bank. The next step that you do is step number 2. You got to list out why is this $39,476 and $39,476.70. You need to build that listing and saying, these are the outstanding checks that I've issued that somebody has not cashed out. Like, for example, 04 was issued. Looks like all of them are issued very close to August 31st. That's why they have not been cashed out. You sum them up. Similarly, if you look at outstanding deposit, you need to make a schedule for that too. What are all the deposits that you believe you got it in, and that's not part, so you get that in. So that's step 2 for you, where you list out all of them. And then step 3 is basically you list out the trust balance as you've recorded in the previous procedures. Basically, you basically go on August 31st, and look at all your ledgers and look at the balance on each of the client, and you say Peter Piper, August 31st, that's the balance. Susan Silver, that's the balance. Terry Taylor, that's the balance. And you also need the last date of activity when you actually deposited or withdrew from trust for that client. Now, this is your internal bookkeeping that you did. So all this information comes from the bank. This also comes from the bank, but this part comes from your bookkeeping software or bookkeeping methodology that you're actually following, and that releases a total amount. Now, by rule, we will consider that your trust reconciliation is complete only when the two numbers are exactly the same. So the bank is copied here is equivalent to your trust listing. So if the two are exactly identical, that means your books are exactly same as what is there in the bank, and you have reconciled every line item. That's what we are actually saying. So for summary purposes, let me just go through. First part, step one, just get every information from the bank, add it all up. Then you list your outstanding checks and deposits, and then you do your trust listing. And at the end of it, you basically give a comparison to say, hey, this is what I have and this is what is there, and the two are exactly the same. And that's what you need to do. Now, is this complicated, or is this really very, very difficult? Now, it all depends how accurately you maintain the books. And it's not just about accuracy of the books. It's also about the timeliness. Like, for example, books can always be accurate, but they may not be done in time. For example, the guy gave you the check on, June the 24th, and if you actually recorded it on June the 29th, you're going to be pretty off from the bank, right? Like, so you want to accurately manage and maintain the records as close as possible to when they actually happen in the bank. And that discipline is what makes reconciliation a much easier task. Actually, we have several cases. If a software does it in a very seamless way, reconciliation should actually be a piece of cake. You should be done in less than 10 minutes. That should be the speed of reconciliation if things were really done properly. Okay, so that's our view. That the fundamental reason why reconciliations are hard is because people do the transaction and don't record them in the books at the right time. So the time displacement between what is recorded and what's actually happening in the bank is very far, and vice versa. Okay. Now let's look at the next compliance documents. What is Freebook, and what does it take to maintain it? Now, Freebooks are basically another compliance document on top of all the ledgers. The reason why Freebook is actually separated from any other documentation is because this is your revenue. At the end of the day, you exactly want to know how much money are you making, and it's very important to understand Freebook very, very clearly. Now, Freebook is a record of all the invoices and the disbursements raised as part of an invoice and recovered from the client. Freebooks also record invoice numbers. The reason why you do need to do that is because you need to track them against payments. Which client was billed, what was it associated, what's the associated tax that you're liable, and the following is a good sample. You have date, the invoice number, the client, how much was billed. If it's a disbursement, you should put it in this column, separate the fee and the disbursement. Then HST is in this column, and the total billed is here, and then you should have a running total of all your total billed Freebook. Now, Freebooks also have a very good purpose. They serve a very good purpose. They basically show you the revenue, of your organization. It basically clearly shows you how much money are you making on a daily basis. If I look here, July is a very, very, very slow month because, the total amount of revenue that's come in here is only, $900, right? It clearly shows you that, July was a weak month. August, is just starting. The first itself was $1,000, so you beat July right at 9th of August. So, Freebook is an indicator of your business revenue, and it's important to manage that. Okay. There are other compliance documents, and we will talk about each of them a little bit and then get into, how to manage them. Form 9A is very important for Ontario, basically because whenever you do an electronic fund transfer, you need to make sure that you record a few very important information: the amount that was transferred, the reason why it was transferred, which bank account to which bank account did it go, and who did the transfer. Was it you or your secretary who did the transfer? And what is the requisition number behind this transfer? It needs to be recorded as well. So electronic fund transfers require Form 9A. Again, and not a difficult form to fill, but a tedious form to fill. Okay. Then many times it so happens that you deal with cash. Cash and trust needs to be very, very carefully managed. The reason why it needs to be managed carefully is because there are rules against cash. You cannot receive greater than $7,500 of cash at any given point of time for a matter. 2, when a cash is received, you basically have one business day, basically 24 hours, within which you have to go and deposit that money physically into your bank, and you need to record it as a deposit slip. Okay, in the deposit slip, you also need to manage and maintain the split of cash, like how many $5 bills, how many $10 bills, how many $100 bills. You need to manage and maintain that, and what's the change. Now, also other documents of compliance that are mentioned in the bookkeeping guidelines is duplicate cash receipts. Like when you actually receive cash, it's very important that you get the signature of the payer and you sign it yourself, and you get the amount and record on what it is being recorded for, and the file number against which this is actually billed. It's really important that you maintain 2 of these. One you give it to the client, and one you manage for yourself. Similarly, like when you're intaking a client, you need to manage client ID verifications and all that stuff. So let's quickly jump back and recap the important documents. The 2 important documents that we in ledgers that we need to manage are trust ledgers and general. We talked fairly in detail what those 2 documents contain. Then we talked about the 4 journals that we need to maintain. We took the Peter Piper example, and we showed when money comes into trust, you put it in receipts. When you invoice, you put it in general receipts, and then when you actually transfer, you take it from trust disbursement journal and actually put an entry in general. Okay. Now, we talked about reconciliation, 4 steps. Step 1 is from the bank. Step 2 is basically a description of your outstanding checks and deposits. Step 3 is from your bookkeeping records, and step 4 is making sure that the 2 are exactly the same. The key metric that you need to make sure that you are managing here is if you record things when they happen, as they happen, reconciliation will be much faster. Moving on, the next compliance document we talked about is Freebook. Now, the Law Society does not talk about expense book, but you can always imagine if there's revenue, you also want to know about expenses too in your company. So we strongly recommend, even though Freebook is just mentioned here, we strongly recommend that good accounting softwares have a good expense book as well, where they tell you what is the expense that was made by this company and who are all the receiving parties, how was it paid, what is the HST that was paid, so that you can match it against the HST received, so that you can file your taxes, at the end of the quarter, right? So Freebook is mentioned, but we recommend the expense book as well as a compliance document. We also talk about other compliance documents like Form 9A, deposit slips, duplicate cash receipts, and other things like client ID verification. Okay. Now let's talk about how much time are you spending in managing all these things. Now, as you saw, everything is a double entry system. Like when things made it as a credit at one place, they are debit at another place. So which means that when maintained, you need to record, and touch every record whenever it actually happens. Sometimes the same information has to be recorded several times. You saw that, what was there in the fee book for example, Peter Piper. So this $565 was recorded several places. One, obviously, somehow it'll show itself in this statement, but that's not important. But you see here 565, 565, 565, 565, 5. So it shows up and in several places, so the same information is recorded so many times when you actually do it, using an accounting system which is not seamless. Now let's talk about what is seamless accounting system. Seamless accounting systems are practice management softwares that lay business rules to do trust and general management. So basically, when you manage your business and you're doing stuff that you need to do, which is basically work, the legal work that you really love to do, and then the invoice that you should love to do because that's going to get you revenue, and then getting paid for what you actually do, which is the best part about the whole work. So when you do all these things that you really love, if the software seamlessly can record all these things automatically and translate it into all these documents, we've kind of hit the objective of seamless accounting. So translating matter management workflows to seamless accounting is a key to saving time. The reason is because in matter management, as part of the workflow, when you're actually recording certain things and raising invoices, if you can generate all these entries so that whenever you need the documentation, we can showcase all these stuff, we kind of achieve the whole purpose. And what makes reconciliation simple is recording the data when it happened. As we tell you, if you can keep the time between your record and when it really happened in the bank as close as possible, reconciliation becomes a piece of cake. And finally, like automatically maintaining ledgers and journals of matter workflow keeps account data and the bank data very close to each other. Like, if you recorded in bank saying that I received money on the 25th and you actually received in the bank on 25th, it's already reconciled. That entry is already reconciled. It's so easy. So that's what makes reconciliation very simple. A classic simplified workflow that automatically translates the workflow into seamless accounting is what makes life simple. Okay? Now, what are benefits of legal accounting softwares? Now, legal accounting softwares allow you to do this, record you the events when they happen and as they happen. Like, for example, if you are using, if your legal accounting software, like ours, allows you to do payment collection via credit card. So let's say it allows you to do that. Now, if the software, when you actually process the credit card, make sure that that processing of the credit card automatically is recorded. We know the success happened. We know the money is in the bank, and it got recorded. So everything actually fell in place right there when it happened as it happened. Recording financial records and bank records as close as possible. Like for example, you actually did, you want to do a Form 9A because you did a trust transfer. You did it in the software. It forced you to download Form 9A. There you go. Financial records in the bank are as close as possible to, the task that you actually perform. Finally, what legal accounting software brings for you is 4 pillars. One is compliance, so that when the law society comes and audits you, it's all compliant. 2 is accountability to your business. You exactly now know how much money is coming in, how much money is going out, how much of this money is actually my money, and how much of this is actually taxes that I owe to the government. Accountability is very important at the end of the day. 3rd pillar is analytics. You want to correct your business in positive or negative direction based on this data that you actually collected. Any data that you have collected, not analyzed, is useless data. All it's telling you is what you actually did. It's actually giving you past information. If it's not put into account analytics perspective, it's fairly useless. And finally, it has to be the most fundamental thing is the ease of use of a legal accounting software. It determines how much time you're actually saving in this whole process. Now, with that, we kind of come to the end of this session about legal accounting. We talked about all the concepts. Let me just show you a software in action. We have about 10 minutes to show the software in action, and then we will talk about how all these things can be done, and then we will take questions in the last 10 minutes. So to do that, I'm going to go out of the presentation. I'm going to go into the software. Let's now take a standard workflow, and I'm going to keep the slides very close to each other. First, we're going to talk about ledgers, right? So for this, I'm going to create quickly a new client, and I'm going to do that Peter Piper, Peter Piper client. Let's do his matter. Let's say, as we saw here, clearly that was Peter Piper's was a corporate matter. So we can say corporate. And, we can mark it as a corporate matter, save, and let's now first take the first thing. There was a $565 that he paid as part of a retainer. So we can go here and say, new retainer, $565, right? Now, we're going to do a payment collection. So we'll say, I want to process Peter because Peter is right in front of me, so I can accept his credit card. So I can say, Peter Piper and his credit card number. And let's say 2319. As you saw here, I didn't even type 565. It automatically took it. Prevents a lot of errors. And we processed it. Oh, I put too many 54s. Process it. Right here you go. As you saw, it's approved. So I know the funds are going to be there. Gives me the reference number. I copy it, paste it, and I can give him a receipt and do an apply. So as you saw, I recorded it as the event actually happened, and I know the money is actually coming into trust, 565, because the transaction was approved. You don't have all that NSF and all that headache, so we know that it was all processed. Now, I made a mistake on how it was paid, so I'm going to go and correct that and go and say, oh, that was not a check, that was a credit card payment, and I've corrected it. So that's my first step towards compliance. Now, let's quickly look at trust ledger. Right? Trust ledger should have date, particular, receipt, disbursement, and balance. To do that in uLaw, you just click on the question mark. It should show me the trust ledger. So I can just click on ledger right here, and it will show me date, particulars, invoice and disbursement was empty, receipt was 565, balance in trust is 565. So as you clearly see, what the Law Society wants you to maintain, you didn't even have to do that. The fact that you recorded the transaction as part of you swiping the credit card allowed you to generate that ledger. So to us, this is seamless accounting. You didn't do the work for the sake of accounting. You did it because it's part of your matter management workflow, and it translated that into accounting. Now, the next part is obviously the billing part. So you can say, legal fee, and I'm going to make it a flat rate of $500 because that was what was done, and it was saved. And let's actually produce an invoice. I'm going to produce, I can do a pre-bill, but in this case, I'll produce an invoice. Now, when you produce an invoice, I'm going to go back to the general accounting. So you basically need to know that $500 of invoice was actually raised on July the 12th, and the invoice number was 002. In our case, obviously, the invoice number is going to be different. Let's look at the general ledger for now. So I'm going to look at the general ledger and click on that, and it clearly tells me July 29th. Oh, sorry, I clicked on the wrong, that's a trust. So let me click on the general ledger. Here, July 29th, legal fee, invoice number, Peter Piper, fee bill here, matches with the example right here. So again, I didn't manage ledgers. I didn't write any ledgers. All I did was I raised an invoice, which is part of the process of billing, and it automatically translated that into this stuff. Now, let's do the act of trust transfer. The trust transfer is, I hit the question mark, and it tells me in red that I need to do a trust transfer. So let me click on Peter Piper and do a trust transfer. And now it allows me to check that. I cannot make any with that because it clearly told me that 565 is what I can transfer. And obviously I did it. I'm going to do an electronic fund transfer. This is where I wait. I actually go to the bank. I'm going to now log in into my RBC, transfer the 565 because the software told me, it'll give me a requisition number. I will put that here and hit the transfer button. And as part of transferring, it forces me to download Form 9A. I download Form 9A, obviously give my general account, RBC General, give my trust account, and I can say RBC Trust, and hit the download button. That finishes Form 9A for me. Here you go. Requisition number, amount, Peter Piper, everything is here, and the signature is the only stuff that you need to do. Now, let's go back to our ledgers. So we need a trust transfer ledger in trust, and we need a general ledger indicating that it was actually transferred. So I'm going to go back to the matter, and I'm going to hit the question mark again to show the two ledgers. They'll be identical. So first look at trust. 565 came in, 565 left. And the reason why it left was a trust transfer legal fee for that invoice. Now if I close that, and if I think somebody's saying that the synchronization is not there, so I'll be a little slow in talking. I'm going to now click on the general. And when I click on the general, you clearly saw, we already saw the 565 was there, that was raised as part of the fee. Now I have the 565 as part of the trust transfer. So if you look here, the entire Peter Piper's trust and general ledgers, we did not do anything in software. The software did the whole thing. All we did was we put the amount, invoice, and transfer. So we did the real work, and the software actually translated all of that into what we call ledgers. Now, journals are interesting. So if you go back to accounting, and if you click on document generation and click on compliance, right, we pretty much lay out what you need to do on a regular basis. Trust, ledger, general ledger, receipt of trust and general as journal, payments and disbursement as journal, the fee book, expense book. We added that because we believe that's a very important criteria, and then reconciliation. So you could basically download each of these, and you're pretty much done. So for example, if I would do, the trust ledger receipt and show only, I should pretty much see the 565 that I deposited. So basically, who was it received from? Why was it received? The amount and the method. It was credit card and here. So if I basically go back to the Law Society guidelines, it's pretty much there. You didn't do that. It just comes out because you actually recorded it, in the workflow. You didn't record it as a ledger or a journal. The software did all the seamless translation for you. Okay, and now it marks as a check mark saying that was actually done properly. Now, similarly, if you do a fee book, right, and let me do this entire month, and I do the download. Now, what the software will do is it will basically give you the fee book. It will tell you, what happened, how it happened. It basically tells you, the date, the client. So let's look at Peter Piper, who was our last client. And it says, Peter Piper today, $565, and this is what was done. Okay. Now, it can also give you a very classical analytics. It can tell you, hey, this month personal injury was awesome. You made so much revenue in personal injury. Accident benefits was right here. Litigation and arbitration was here. Small claims is not bad, but things like criminal law, real estate, those things did not do that well. So in 2 seconds, translating this into analytics completely opens the dimension of understanding your business. Now you exactly know, who paid what by category, what is important, you know all that stuff. Personal injury, very high, right? It's really good. Now, you can also get that in terms of client. What does it transfer? Probably Simon Garfield was a personal injury client. Let's quickly go and check. My suspicion is that would have been Simon Garfield. Should have been a personal injury. There you go, personal injury client. And that's the reason why, that revenue matched up with such a high volume of dollars recognized as revenue. Very important information. Basically tells you how you need to do and plan your next month. Where should you be your investment dollars? Probably you should be throwing more money and advertising more about your personal injury business rather than focusing on small claims, right? Kind of gives you that idea. Okay. Now, if you go back, we already showcased to you Freebook, Form 9A, deposit slips, everything in the software just flows by the very nature, basically because you did the work and all the analytics is all available right there. Now, again, you should be able to look at the same information in different ways. Like, for example, I can look at it as a category. I can say, I want to look at this month, as a category, which was what happened. And as I look at it by category, right, as a pie personal injury making its largest, or as a bar where I exactly know personal injury making. The same information, I can compare it for last month. I can say, look at my category. Is it only this month that I made good money in this, or was it like sustainingly personal injury was good last month too? And if you take it last month, clearly personal injury was not there. Like, small claims seems to be there. Criminal Mississauga and employment made its way. So, it clearly tells you, in comparison, month by month, your analytical view of what is there. Now, you can't get all these things if you don't have software that can analyze the data. So just recording is only one part of it. Analyzing and presenting it to you is the other part of the equation. So coming back to our final summary slide, compliance, accountability, analytics, and as you saw, ease of use. Like, right in front of you, I just did a few jobs, and then all these documents just, came one by one. Now, let's look at reconciliation. Now, reconciliation is always interesting, basically because I need to know a few things. Like, so if I click on document generation, reconciliation, trust, okay, now what are some of the important things that I need to know as part of reconciliation is I need to know my total bank balance. So let's say it is 236,560.00, right? And let's say 75 cents was my bank error, right? And now let me choose that. So that means let me just make that if that was the bank balance, and that was my outstanding check, and bank had a 75 cents error, right? It totals me up, and I finish my reconciliation. That's it. Now you'll see that in my reconciliation statement, I talked about 4 things. Step 1, which I just filled in. Step 2, doing this, and step 3, doing that, and last, validating it. So now when I open my reconciliation, step 1, step 2, and then step 3, which is by far the hardest part of reconciliation because you need to go for every client and find the last date of activity and the balance. The software automatically gives you that. And then the last statement where it says the two are identical. Reconciliation is complete. So I basically did reconciliation right in front of you in a couple of minutes. So if things were recorded at the right time and things match between bank and you kind of know exactly what's done. The only action that you need is call the bank and fix that 75 cents bank error, which could be some transaction fee or something like that they put, and you're pretty much done. So going back, we talked about a good matter management workflow automatically translating into a very clean accounting ledgers and documentation and compliance. So with that, we kind of come to an end with respect to the presentation. If you like our presentation, you can go up to our website, which is uLawPractice.com, and sign up for our free 30-day trial. We will basically give you a demo of the software and the workflow and basically talk about accounting. Primarily what the software is meant to do is accounting in the back seamlessly while you actually practice in the front. So at this point, I'm going to open up chat lines to see if there are any questions. And the first question that I have is, what is expense book? You talked about it. You never showed it. Yes, that's a good question. Let me go back to the software. Now, we talked about Freebook a lot. That's basically revenue. Let me quickly show expense book. And when you say download, let me just do a monthly expense book. It basically has to show you all the expenses that you've been having, like business expense, corporate expense, client expense, and summing it all up. So in this case, it clearly said $1,200 was the expense that we had for all the revenue that we made. This is expense on the client. Bank charges was that much. Printing and stationery was by far one of the largest expense that we had. And this is how it basically came down to. These are the clients for whom we did all the expense. Obviously, this person is the largest. Business and corporate expense was about $303. And again, it sums up everything as an expense and gives you that analytical view. Now, expense book and fee book are pretty identical when it comes to data entry. Like, date, client, description, HST needs to be managed, and, and the total. So that way, at the end of the day, you kind of have the total. Even if you add any kind of credit memo or something like that, that's managed as well. The next question that I had is, how do I apply for my CPD? Okay, very important. Please send us an email at info@uLawPractice.com so that we can mark you up as attended. And once you've marked you as attended, you actually go to the LSUC website. You will see our webinar listed as one of the courses under uLawPractice. It will be Law Society Bookkeeping Compliance. Again, the email is info@uLawPractice.com. You send it, and we will mark the attendance, and you need to go and give it. So that's a good question. We got that covered. The next question is, is about Form 9A. Do I need to do it for every electronic transaction? Absolutely, yes. Every electronic transaction you need in trust, you need to have Form 9A, whether it's a mortgage payment withdrawal or just anything that you're doing electronically. Absolutely, you need to, basically record it. And that comes pretty much in our workflow too. If you basically did some form of trust transfer, which was basically not electronic, we would not do that. And again, coming back to this matter, which we just did, the corporate matter, right? Making sure that the trust errors are minimized is very important. Like, for example, if I click on the action and try to do a trust invoice payment transfer, it should tell me you don't have anything to transfer, basically, because everything is actually done. So even if I try and select, it's going to say, no, $0. There's nothing to transfer. So that way you don't have trust errors. You're not doing double transfers, mistakes. One person is doing the same thing, other person is also doing the same thing, and you end up transferring twice. You're not having all those kind of errors. Okay, so that's the key with respect to using software. So let's summarize with our final slide and start our long weekend. The key benefits of legal accounting software is recording the events when they happen as they happen, recording financial records and the bank records as close as possible makes reconciliation a simple task. What you want to manage is you want to have a very compliant system, a very accountable business practice, produce a lot of analytics so that you can think about your business in your downtime, and finally, it's all about ease of use. So with we come to a conclusion of this webinar. From uLawPractice, Praveen and myself would like to thank you for taking your time on a long weekend and attending this webinar and making it a great success. Again, please don't forget to send your email at info@uLawPractice.com about your attendance, and we will have you marked up, and obviously go to the website and present it as well. Thank you so much, and we look forward for another webinar. Join our newsletter, and you'll hear more about our CPDs and webinars. Thank you.